Even with timely payments, your credit score can drop due to credit utilization. This is a crucial factor affecting loan approvals, interest rates, and credit limits. This video will explain that credit utilization is a ratio. It compares the amount of credit you're using to your total available credit. It's calculated as your balance divided by your total credit limit. For instance, imagine you have a credit card with a $10,000 limit. If your current balance on that card is $3,000, your utilization is 30%. This is a simple calculation, but its impact is profound. Credit scoring models prioritize this ratio above many other factors. They view higher utilization as a sign of increased risk. This holds true regardless of whether you make your payments on time. Many people believe that as long as they pay their bills, their score is safe. But credit utilization can tell a different story to lenders. There's a common rule of thumb: try to keep your utilization below 30%. Staying below this threshold generally suggests financial stability. It indicates that you are not overly reliant on borrowed money. However, ratios above 50% can significantly increase perceived risk. Lenders might see you as a higher risk borrower. This could lead to less favorable loan terms or even denials. Conversely, lower utilization ratios generally lead to better credit scores. The closer you are to 0% utilization, the better. It signals to lenders that you manage your credit responsibly. You're not maxing out your cards. Understanding this ratio is fundamental to maintaining a healthy credit profile. It's not just about paying on time, it's about how much of your available credit you use. This single factor can be the difference between approval and denial. It can also dictate the interest rates you'll pay on loans. So, always keep an eye on your credit utilization. It's a powerful lever in your financial health. Manage it wisely to unlock better financial opportunities. Now, let's delve deeper into why higher utilization signals higher risk to lenders. Even if you consistently make your payments on time, a high utilization percentage can still negatively impact your credit score. This is because credit scoring models are designed to assess probability, not just responsibility. They look at the likelihood of future repayment issues. When a model observes larger outstanding balances relative to your credit limits, it interprets this as increased borrowing pressure. It suggests you might be relying heavily on credit to cover expenses. This behavior, from a statistical standpoint, correlates with a higher chance of default. It's not a judgment on your personal financial habits. Instead, it's a cold, hard calculation based on vast amounts of data. The model doesn't care about your income or savings directly. It focuses on how you manage the credit you have been extended. A person with a high income but maxed out credit cards might appear riskier than someone with a lower income who uses only a small fraction of their available credit. This is a critical distinction. The model measures the probability of you struggling to repay. It's not measuring your intent or your personal financial discipline. Therefore, even if you are a responsible payer, a high utilization ratio can still categorize you into a higher risk group. This perception of increased risk can lead to less favorable lending terms. It could mean higher interest rates on new loans or credit cards. It might also result in lower credit limits being offered, or in some cases, even outright denial of credit applications. Understanding this underlying mechanism is key. It helps you appreciate why managing your credit utilization is so important. It's a direct signal to lenders about your financial health, and it's one of the most influential factors in your credit score. So, keep those balances low to signal stability and reliability. Building on our understanding of the overall credit utilization ratio, it's vital to recognize that this metric is assessed at two distinct levels: your overall utilization across all accounts and the utilization on each individual card. This dual perspective is crucial because both can significantly influence your credit score, sometimes independently. Imagine you have 3 credit cards, each with a $10,000 limit, totaling $30,000 in available credit. If you've spent $1,000 on 2 cards and $8,000 on the third, your overall utilization is $10,000 out of $30,000, which is a respectable 33%. This might seem acceptable, falling just above the commonly cited 30% guideline. However, that one card with an $8,000 balance is at 80% utilization. Even with a moderate overall ratio, a single card nearing its limit can send a red flag to credit scoring models. This high per-card utilization suggests a potential over-reliance on that specific line of credit, which can negatively impact your score regardless of how well managed your other accounts appear. It's not just about the total. The distribution matters significantly, painting a more nuanced picture of your credit behavior. Another critical, often misunderstood aspect of credit utilization involves the timing of balance reporting. Many people mistakenly believe that their credit utilization is calculated based on their balance on the payment due date. However, card issuers typically report your balance to credit bureaus on your statement closing date. This distinction is incredibly important for strategic credit management. This means if you make a large purchase early in your billing cycle and your statement closes before you pay it off, that high balance will be reported, temporarily inflating your utilization ratio. Let's illustrate with an example. Say your statement closes on the 15th of the month, and your payment is due on the 10th of the next month. If you charge $4,000 on a $5,000 limit card on the 10th of this month, and your statement closes on the 15th, an 80% utilization will be reported to the bureaus. Even if you pay the full $4,000 by the due date, that high balance was already captured and sent to the bureaus. This temporary spike can cause a dip in your credit score, even if you're financially responsible and pay in full. The good news is that credit utilization is one of the fastest moving factors in credit scoring. Unlike payment history, which has a long memory and impacts your score for years, utilization is more of a snapshot, reflecting your current borrowing habits. As soon as your balances drop and a lower amount is reported to the credit bureaus, your score can respond quickly and positively, often within a month. This means you have a direct and relatively immediate way to influence your score by managing your spending and payment timing effectively. For instance, if you anticipate applying for a loan soon, paying down your credit card balances before their statement closing dates can significantly improve your reported utilization, potentially boosting your score just in time for your application. This proactive approach can make a real difference in the rates and terms you're offered. Understanding this balance to limit ratio, both overall and per card, and the crucial timing of when these balances are reported is absolutely key to mastering your credit. It empowers you to proactively manage one of the most powerful and dynamic components of your credit score. By keeping a vigilant eye on both individual card utilization and your overall ratio, and by strategically timing your payments to ensure lower balances are reported, you can maintain a healthier credit profile. This proactive approach not only helps in achieving better loan terms and higher credit limits, but also provides peace of mind, knowing you are in control of your financial reputation. It's about being smart with your credit, not just responsible. Remember, every percentage point matters when it comes to utilization. Even small adjustments can lead to significant improvements in your credit score over time. So, make it a habit to check your statement closing dates and plan your payments accordingly. This simple strategy can prevent unnecessary dips in your score. Ultimately, a strong understanding of these nuances will serve as a powerful tool in building and maintaining excellent credit. It's not just about avoiding debt, but about demonstrating responsible credit management. This knowledge allows you to optimize your credit usage for maximum benefit. Don't let a misunderstanding of reporting dates hold your score back. Take charge of your credit utilization today. It's a fundamental pillar of your financial health. Mastering it opens doors to better financial opportunities. Your credit score is a reflection of your financial habits. Make sure it's telling the right story. By being mindful of these factors, you're investing in your financial future. It's a small effort for a significant reward. Start optimizing your credit utilization now.